Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show monthly market update episode for this month of March 2017. I'm here with our expert economist and wealth advisor, Paul Sloate, founder of Green Drake Advisors based in Wayne, Pennsylvania. Every month, Paul joins us here on the show and fills us in on the economic forces at work in the national and global economy and what those forces are expected to do to the local real estate investment markets in the short and long term. This month, Paul presents some very valuable insights for developers and any other real estate investor who is involved in the purchasing and installation of building materials. In other words, if you fix up houses, you'll want to pay close attention for the next 15 minutes or so. You know, I really feel sorry for the blithering idiots who never take the time out of their day to soak in this kind of wisdom that allows you to prepare for the market changes coming down the pike and not lose a big pile of money. In fact, I was the blithering idiot back in 2008 who was so happy to be finally cranking $10, $20, and $40,000 checks from real estate deals that I was completely oblivious to the coming crash and doom that occurred from, 2009, 10, and 11. And I wasn't alone. Back then, I didn't care about things like interest rates and the price of copper. I was making money, and I thought I had it all figured out. Now it's different. I thank God for the opportunity to speak with such brilliant minds here on the podcast show every week because each guest brings a unique perspective which forces me to think about my business in new ways. And on this episode, as with each monthly market update, Paul sheds light on a few items I was blissfully unaware of previously, but which will have a reaching impact for all single-family investors, including myself. I'm glad I took notes. Ready to get started? All right, welcome back to the show, Paul.
Well, Dan, it's good to be back. So how are you on this fine spring day?
Doing well. For the listeners' benefit, we're talking about March 9th, 2017. How about yourself, Paul?
Well, I'm enjoying the day. It's a beautiful spring day here in Philly. Hard to believe that we're having this weather in March, but it's in the low 60s here. So things are really nice outside right now.
So we have about 29, maybe 32 degrees in Chicago, and we had our 55 or so degree weather yesterday. So if the patterns continue with the weather like they usually do, you guys there in Philadelphia get our weather about a day, day and a half behind usually. So I think it'll probably be cold for you tomorrow. I got to be the bearer of bad news.
Yeah, well, I think you and the weathermen agree. They say it's going to snow here tomorrow.
Nice. Gotta love it. We've discussed the future of the weather forecast. So how about the financial forecast, Paul?
All right. So as we've discussed in the past, we like housing long term. However, we think that the period of accelerated growth is over for housing. You're going to get nice steady growth here, especially as the millennials move into their prime home buying years. Interesting statistic, which I will mention here, is that for housing, what we have is that the housing affording index is now back to the average that we saw from the early 90s until about 2004 before we had the housing bubble. So I would say that we're back into a normalized housing market. Now, yes, there are some areas where housing is a bit overheated and where home prices are out of line with the underlying incomes in certain particular markets, but for the overall country as a whole, where we are is back to average is what I would say. And so I'd expect steady growth in the housing market over time. But for those involved in turning houses or building houses or fixing up houses, there's something that you should be aware of. And that is that inflation in the materials that you are going to be using in fixing up or building homes is going up. And this has been held down by the significant rise in the dollar over the past 5 years. However, there are two things we think are going on. First, we think the dollar is very close to a peak from a long-term perspective, so that tailwind will go away. Secondly, when we look at the fundamentals of a number of commodities around the globe, what we see going on is that fundamentals have tightened up and that pricing is likely to be stronger for these industries than over the last few years. So here's a simple example. Let's talk about insulation. What's going on in the insulation industry in the United States? Well, insulation has been very modest in terms of price increases over the last few years. However, the manufacturers of insulation have just put in a 5 to 10% price increase. That is meeting little resistance. That's because industry-wide capacity utilization is in the low 90s currently. It is projected that should building continue to increase at a modest rate over the next 12 months or so, that by the middle of next year, the capacity utilization in the insulation industry would be in the high 90s. Now, what this would do is maybe bring a little idled capacity back on, but more likely we would see further price increases in the price of insulation. So we could see another 5 to 10% next year. So for the average person, they're looking at buying insulation for either a fix-up or for a new home they're building for a client. They should be aware that the price of their insulation is going up. This doesn't apply just to insulation, so let's take another simple thing like copper. Copper goes into every electrical wire in a home, and it goes into things like boiler motors and other things where they might create electromagnets in the appliances. So the price of copper is likely going up. Global supply and demand in copper was in balance. And then we've had a couple of disruptions at major mines in the world. So what's going on currently is that we are drawing down inventories at an aggressive rate globally, and this likely will lead to higher prices for copper, which will then flow through to copper wiring in everybody's house, copper piping that's used for water, etc. So any place you might find copper, you're going to see a higher price for that. Let's go on to something else. Let's go to something simple like plastic. What's gone on? You've seen a recovery in oil prices over the last 12 months. And we expect, even though oil prices are pulling back here over the near term, which is the normal seasonal, especially as we did not have a winter here in the East Coast, we would expect that energy prices would resume their rise later this year or in 2018. For those who want to think about this, oil prices determine much of the basic price for many precursors of plastics, such as ethane, propane. Those are the things that go into plastics, and those are the things that are priced off of oil. If we were to look at something like ethane, you've got something else going on. It's selling at approximately its fuel value. So it's a discount to where it normally sells relative to plastics. Well, what's going on is that we have a lot of new plastic plants coming on in the U.S. over the next 6 to 12 months, and it is projected that by the end of 2018, these plants, in combination with some new export terminals, will chew up all the excess supply of ethane. That will push the price up potentially 30% or more for the ethane that goes into chemical plants to make building block chemicals. So all your PVC pipe and other types of plastic piping that go into a home could start to see price increases. In addition, if we look at lumber prices have staged a major recovery. If single-family home building continues to go upward, what will happen is that we will see more price pressure upward on lumber. And that looks like where the market is headed towards. So as we see more price pressure in lumber, that will feed into everything that goes into house in terms of building the house. Lastly, if we think about things like brick and other things that need energy to manufacture them, the recovery in oil prices has increased the cost to produce basic things like brick or concrete, because concrete's produced in big clinkers and other types of plants that use a lot of energy. So we would expect that those prices would be going up as well. So when we look at all these various pieces and things that you need to build a house, it's going to cost more. Whether it's putting concrete in for a foundation, whether it's putting stone in that goes below that concrete, whether it's putting in your piping, whether it's putting in your electrical wiring, whether it's putting the asphalt shingles on the roof, they're all going to cost more, and pricing is going up. If we should have the U.S. dollar peak out and start to come down, then pricing would advance at an even more aggressive pace. So we would just note that this is something that builders and people who are buying and selling houses and need to fix them up in between should keep in mind. Previously, we have talked about labor. The labor market continues to tighten. We expect that wage rates will continue to accelerate as the Fed wants wage rates to accelerate and as the labor market continues to tighten. So the latest statistics from ADP show that we created 300,000 jobs in the last month. Balanced with the low number from last month, we're creating over 200,000 jobs per month on average. That's a pretty good number and will continue to tighten the labor markets. Wage rates have already been going up, and it is likely that wage rates will accelerate. So that is something else that people should keep in mind. We are not worried about the infrastructure program planned by the government because even were that plan to pass today, it would take 12 to 24 months at a minimum before any of those projects that are discussed would place any demands on the market. So as we look forward, we're going to see labor inflation and material inflation. So as you buy and sell your houses, you need to think about this and think about how this is going to impact your margin over time, because home prices are only going to go up so much, especially with mortgage rates continuing to rise. Now, while we've had a near-term pullback in interest rates, and they may pull back some more, we think that the intermediate-term course of interest rates is upward. This will put more costs onto the borrower and limit the price increases that we are seeing. We have seen prices roll over in some markets like New York City, and we expect them to roll over in some other markets. So you have to be aware that pricing is not going to bail you out, as the cost to do everything you are doing to the houses will continue to escalate this year and next year. So it's time to go sharpen your pencils and make sure that you are paying the right price for the right property in the right location, because otherwise it's going to get harder and harder to make money at what you are doing. And please note that should President Trump truly clamp down on immigration to this country, longer term, this will put upward pressure on labor rates because the growth rate in the labor force will be less. So those are a couple of key things on the inflation front that we should all think about. And let's take a turn away from housing and let's go to the hotel industry. As we have discussed before, we have seen a significant acceleration in supply into the hotel industry. We had been expecting this for some time, and it is starting to impact the hotel industry. There are currently 190,000 rooms under construction. We're on a base of 5.1 million rooms, or almost 4% of current industry capacity. In addition, there's another 575,000 rooms in the active development pipeline. So that's another 11% of industry capacity. So as we're coming into a late cycle environment, as the hotel industry often does, we're seeing lots of supply starting to show up. So if you're investing in hotels, you have to understand that RevPAR is going to slow down, the valuations are likely to come down, and furthermore, with rising interest rates, the cap rates that investors will apply to these properties should go upward. And for example, as we have commented on RevPAR growth in 2014 was 8.3%. And for those who don't know what RevPAR stands for, that stands for revenue per available room. However, by 2016, this had slowed down to just 3.2% because of increasing new hotels that were being added to supply. This year, RevPAR is only up 1.1% year to date. So we've had a significant slowdown, especially with all this supply waiting in the pipeline. And by the way, just so we should know, there has been 2.3% rate growth, which means that occupancy is down 1.2% year to date. That's not a healthy sign for the industry and ultimately will put pressure on pricing and may turn RevPAR negative. We would note this could happen even before we have a recession, which would only exacerbate this situation. So for those in the real estate business looking at hotels, we have a caution flag up because fundamentals are deteriorating here, and they would seriously deteriorate in a recession as a number of hotels under construction would still come online, even though industry was headed downward. So that is my updates for today. Do you have any questions on today's quick update, Dan?
Yeah, I got to say, I'm sure that anybody who's listening is, really patting themselves on the back if as long as they were paying attention to this episode here, because I know so many in our audience are real estate developers or fix and flip investors and or are associated with that. And even people who are doing rentals, Paul, you still, at least I'd say 95% of the people that I know who do rentals are picking them up in distressed situations and then completing construction prior to renting them out. So knowing that we're probably going to see these price hikes in building materials and labor coming down the pike, is definitely solid, valuable information. Would you have a guess as to the percentages of increase we might see within the next 12 to 18 months? Are we talking like 30% increase across the board when we add all this up? Or would you say that, even a 10% or 15% increase is still going to be catastrophic to a lot of projects, but would we be talking about a 10 to 15%, Paul? What would be like the percentage?
I would say for most things, it's probably going to be, so your labor, depending, if it's specialized labor, right, then you could probably be looking at a 5 to 10% increase in your labor costs. If it is, generalized labor, maybe 4%, right, unskilled labor. If you're looking at things like, some of these metals, you're probably talking about it's going to depend. And here's what it depends on. So if we were to look at copper a little more closely, what you've got going on is we have a couple of major mines that are offline right now. Now, copper is drawing down global inventories. If those mines don't come back online before year end, you could end up in a shortage situation and see copper prices have a spike of 15 or 20%. If they do come back online, it would contain the copper price rises to maybe 5%, maybe 10%. So a lot's going to depend on factors outside of people's control. But what we can say about copper supply going forward is the following. Number one, output from existing mines around the world has been somewhat disappointing because prices have been low and people have not spent a lot of money to maintain and grow their production. And number two, the other thing that we can say is that there's really very little new mines in the pipeline in either pre-feasibility studies or under construction for copper. So supply growth in copper is going to be pretty constrained over the next few years. And that's just something to keep in mind. The only mitigating factor here would be if China had a major slowdown and significantly cut back its infrastructure spending, then you could see a little lessening of demand growth, which would loosen things up a bit. But outside of that, copper is likely to get tighter this year, tighter next year fundamentally, and probably tighter in 2019 as well, based on the data that I have seen. So I think it's going to be material by material, but like for insulation, we think insulation prices are going up 5 to 10%. Price increases have just been announced, and there's very little pushback here, and we expect them to go through. And it's likely if insulation tightens up again next year, as we think it will, you could see another 5 or 10% next year. So in the case of insulation, you could be looking at 10 to 20% price increases over the next 18 months. Is that helpful, Dan?
It is. And what happened, Paul, to knock off these copper mines that have gone offline?
Well, here's what happened. In 2014, remember, the price of oil collapsed. And in 2012, 13, and 14, the price of many metals collapsed because global growth slowed, global growth in China slowed. And remember, China was growing its infrastructure, its fixed asset investment at almost 20% a year. That, over the long term, is unsustainable because the compounding effect of 20% is, right, you double every 3.5 years. And so what happened is it got to be such a large number, it's the law of large numbers, it slowed down. And what happened is you still had all these mines in planning when the demand growth slowed. So the mines came on and the demand wasn't there. Well, now we've stopped building mines. The demand's caught up. And so therefore we're now in a balanced market, excluding any mines that are offline. So I would say what's happened, it's a lagged impact. Things happen with a lag in commodities. So you had maybe 3 down years, and now things have come back into balance. So now you could have a few years where they head upward. Is that helpful?
It is. It is. Thanks, Paul. And I have one more question written down here. Toward the beginning of our talk here today, you mentioned the housing being overheated in certain markets. Do you happen to have a list of those overheated markets you could share with the listeners?
I don't have that list with me today, but for next month, I'll make sure to put that list together, and we can discuss the list where the prices have become out of line with the underlying incomes of the people buying the houses.
I'm writing that down. I'm sure some of the listeners are too, and we're going to hold you accountable for that, Paul.
I will make sure to produce it, Dan.
Cool. So do you want to give the listeners a place to go or some contact information in case anybody'd like to reach out, and maybe who should reach out to you, Paul?
Well, anybody who'd like to discuss in detail what we discussed here, or to discuss how what we do might help them in their business or in planning their financial future, they should reach out to us on our website at www.greendrakeadvisors.com, or they can call our offices at 610-687-7766, and we'd be glad to help them.
And Paul, you send me this letter, and I don't know if I'm supposed to announce this or mention it publicly, and if I'm not supposed to, I'm sorry, but this letter has a ton of great content. Is that something that you make available for your other contacts, clientele as well? Is that something someone could get a hold of you about, Paul?
Well, the way we're working the letter is for our industry contacts like you, Dan. We've made it available. We've made it available to our clients and to a select group of other people, and we could potentially make it available to people who want to contact us and receive it, but it depends, and it likely sometime next year, those who are receiving it will continue to get it, but then we're likely, for those who are not clients of the firm, to go to some sort of subscription-based process whereby they are going to be paying for our letter. And I think you would agree that it is worth paying for.
Solid stuff. Sorry if I wasn't supposed to mention the VIP letter and put you on the spot there, Paul.
That's okay. The letter we tend to get a lot of good feedback on the letter. We only put it out once a month, as you know, because it takes a lot of time, energy, and effort to properly research the letter. But what we produce, we think, is value add for all those who receive it.
Absolutely. Paul, thank you for sending me the letter. Thank you for, taking out the time today to give us this great report here on what to expect in housing. I appreciate your time, and I appreciate you sharing your wisdom with our listeners.
Well, thank you for having me, Dan, and I look forward to speaking to you next month.
And thank you for listening to this episode of the Monthly Market Update, REI Diamond Show. Are you interested in receiving an email notification the next time I release an REI Diamond Show episode? You can either sign up at www.reidiamonds.com or subscribe through one of the podcasting apps, including iTunes, Google Play, and Stitcher. If you sign up at reidiamonds.com, there's some cool bonuses there, including a 165-page book, which I wrote on finding off-market deals. Yo, you got deals for sale? Go to www.reidiamonds and click the link at the top of the page to send them over. I am buying now in Philadelphia market, New Jersey, Delaware, Maryland, Chicago, Atlanta, and the Tampa Bay region in Florida. And I thank you again for being a loyal listener of the show. Dan Breslin here, signing off.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.